Are you seeing a similarity between '07 or '08 and what's kind of happening now, or not? Is it different?
It is getting back to there a little bit because our products that were coming back, we got a 40-year mortgage now, so it allows people to expand that mortgage payment out an additional 10 years, so that way their mortgage payment is less than that 30-year term. I've seen some stated income loans coming back, especially for the self-employed investors and borrowers that don't want to give up all their information, tax returns and things like that. So it's coming back, but the products aren't as unrealistic as they were back in 2007, where if you had a heartbeat, here you go, here's your loan and here's your house. Good luck.
Right.
So the banks aren't, being that ultra aggressive, but
they are starting to. So those are the products I thought were interesting that some of you might think that are interesting is, if they start doing 40-year loans, because that's a new product for you, right?
Correct. Absolutely.
Yeah. So basically a 40-year loan is going to help increase housing prices because people always solve to a payment. So if their payment is then divided by 40 instead of 30, they can then afford it, which then kind of increases, could increase the price of the house. And then the stated income is interesting for people because it's way easier, but it's a higher interest rate, right?
Correct.
Like, what's the difference? Are you, not without quoting, like, is it
probably a 1.5% to 2% difference?
Okay. But that's really good for some of us entrepreneurs that maybe don't claim a lot of income or don't make, on paper, but then are able to get a loan.
Absolutely.
Is seller carryback loan a good option for someone who can afford the monthly payments but can't qualify for a mortgage loan?
If the seller's willing to do it, then absolutely. The seller carryback itself, you have to negotiate those terms with the seller, right? So if the seller is actually willing to carry back part of that mortgage and give you a reasonable term, and you have a good option in the future to take the seller out of the equation, then why not?
Right. Well, and seller carryback, you assume their mortgage, right? So if they have a low rate, like a 2.6 or something, that's what you're assuming?
Well, it could be. There's different ways to do the seller carryback, whether it's, what if you're putting down 20%, 30% and your DTI is just not high enough and they're going to reduce their purchase price, to make sure that your debt to income ratio is lower on that home loan. There's hundreds of different ways to structure that transaction. But ultimately, like I said, it's what if the terms are, within reason and it makes sense for you and your family, then by all means. It's not uncommon for seller carrybacks, but you got to make sure that you put yourself in a good situation where, the terms are right for you and your family.
Now, let's just talk about getting qualified for a loan too, because I think a lot of people listening have never gotten a loan or they haven't gotten a loan recently, so in this new environment. So what are things people could be doing to prepare to get a loan and get qualified? Should they get pre-qualified? Like, what should they do?
Well, absolutely. The first thing to do is always try to get pre-qualified, whether it's if you have a friend in the business that's a loan officer or myself. Calling a loan officer right away to get your credit pulled is the main thing. Everybody has these free credit reporting services, right? And I'll get calls all the time like, hey, my credit's an 850, right? Nobody has a perfect credit score. I've been doing this for 15, 16 years. I've never seen an 850. So, you try to educate them about the credit and how the free credit reporting services are not entirely accurate. So once you get dialed in with, a loan officer, that they pull a mortgage rating, and that's going to be your most accurate credit report, of your lifetime. You get Experian, TransUnion, Equifax. We use the middle of the 3 credit scores to do the qualifying. And then based off your income and your debts, we come up with a debt to income solution based on the purchase price of the home that you're looking to purchase or refinance. So, absolutely. And everybody's always like, hey, if you pull my credit, is it going to ding me? Well, it's just a credit inquiry. It's not like you're going to drop 100 points, getting your credit pulled. So that's definitely a big misconception in the mortgage business too. And they've changed the algorithms a little bit now. So if, let's say you were looking to purchase a house, you call me, I pull your credit, you usually get within 30 to 60 day grace period. You could literally probably have 10, 12, 15 different lenders pull your credit, and it's going to stay pretty much the same.
And, when you get pre-qualified, like, what's the point of that? Because I know a lot of people, they don't want to get pre-qualified because they're afraid to make that move because they feel like now they have to go find a house and maybe they're not ready. But like I always tell, like my brother's one of those people and I'm always telling him, no, just get pre-qualified. That way, if you find something, people take you seriously, because they don't really take you seriously if you're not pre-qualified, right?
And if you don't, because we are the one that initiates those pre-qualification letters. So if your agent doesn't have a pre-qualification letter, they will not be able to submit an offer.
The banks are the worst. So like, I never really recommend, especially entrepreneurs, go that route. But these private loan companies can be very, very good, and they're all insured, and they're legit. You just have to think outside the box a little bit.
Absolutely. And a lot of times they just don't have the products that, I have the ability to obtain, with a mortgage banker, right? We're reaching out to other investors to invest within our company to obtain additional mortgage servicing products, right? We have bank statement loans now. We have a no-doc. We have an investment loan, which I'm sure Ken would love for me to promote. Is basically it's any investor out there purchasing investment properties right now, you can put down anywhere from 10 to 25%, whatever it may be. But if that property itself, the fair market rental payment is less than the payment that you're qualifying for, that's all the documentation you need. So it's kind of like a no doc, but as long as, like I said, as long as that payment is less than the fair market rental payment on that appraisal, then there's really no other information that you need.
Oh, that's great. So if the rents are more than your mortgage, basically, then you'll be set to go without having to prove income and all of that.
And if you need to, like I said, you can back that payment however you want with the down payment funds too, right? So if it's like just, above it, then you can put slightly more money down, or you can buy down the interest rate, however you want to do it in that situation. But it's a really easy loan for a lot of those investors out there that don't want to give you all your tax returns, W-2s, 1099s.
It's a pain.
Schedule Cs and anything of that sort.
For those first-time home buyers, I just helped a girl buy a home. She's 22. She only needed like 4% down or 5% down, which was like, for her home was like $12,000.
Yeah.
So talk about that, because people don't know that.
Well, what a lot of people don't realize either is down payment assistance programs. There's, a few out there. I've actually closed transactions where they've only brought $1,000 to the table on some of these down payment assistance programs. They're a little bit more harder to qualify, meaning that the debt to income ratios will not exceed a lot of times 43%, which means the mortgage payment plus their monthly debts can't exceed a 43% back end ratio. But we also have first-time home buyer programs, 3% down if you're a veteran, 0% down. So don't ever just assume that 10% or 20% is the amount that you need to purchase a house, because you can get in a house with $1,000. It's just you got to take the steps to get qualified and pick up the phone and call a lender and get pre-qualified.
And some of those prepayment programs were a little more difficult when the market was hot, because people didn't want to deal with them, right? They wanted like all cash buyers and all that, right?
Correct.
But now that the market's slowing down, it's easier if you're in these programs to still be able to buy something.
Absolutely. I mean, down payment assistance isn't always a bad thing. And I like to call them just starter loans, right? Because at the end of the day, the rates are going to be typically higher, because that's how they get their money to pay you for those down payments. But you always have the ability to refinance. And if you believe that the rates are going to eventually come back down, you'll eventually refinance.